Our mining company Coal of Africa reported a loss for the 6 months ended December of 13.36 cents per share compared to a loss of 12.3 cents per share previously. Joining us in studio for more on the numbers is the company's Financial Director Wayne Koonin. Wayne, thanks so much for joining us today. Let's drill down into these numbers and let's look at what the loss is being attributed to here, because as I say, a loss coming through that's greater than the previous comparative period, and that despite revenue up significantly, and that despite your export quality sales up on international markets as well.
Sure, thank you. That's correct. I mean, obviously, as we also in many businesses, the rand-dollar exchange rate was a lot weaker at the year end at 31 December. It was at 8 Rand 13 compared to a significantly lower rate at year end. So $38 million of our non-cash items was attributable to an unrealized foreign exchange loss. We do expect if the rand holds steady at the current rates of around 7.55, by the time we report our full year results, that this would reverse either in part or in full. The other aspect was also a $28 million charge for depreciation and amortization. That is consistent with the prior 6-month reporting period. And if you strip that all the way back, you basically get to an operating loss of $4 million in the current period compared to $32 million in the prior 6 months.
So what we're actually looking at here is a company that's slowly turning the corner and making steady progress at it. Let's look at how, because we've had John Wallington, CEO of the company, in studio in the past, just talking about what's been a very significant development over the half-year period, and that was the lifting of the suspension of that water license at the Veolia colliery, and on the back of that, you've started maiden coal extraction at that facility.
That's correct. Yes, we're very pleased. If you look back over the 6-month period, it was a very, very busy period, but the turning point was definitely once the the suspension of the water license at Veolia was lifted, and we were able to complete the construction of the plant and commence mining operations. So to date, just through the months of January and February, they've moved 500,000 cubes of waste material and 13,500 tons of run-of-mine coal that's sitting ahead of the plant. We've commenced with the washing of that coal and also sending product to our customers for testing so that we can start to establish markets and purchases of the coal.
Let's explore some of the viability of the targets that's been set here, because first sales are targeted for the 4th quarter of this year. And speaking to traders out there, you know, they're very skeptical when they hear things like this, because they say projections and projects leads to very high time for high time, but there's, the delivery of that is actually lower when it comes to the crunch.
Well, certainly if you look at Veolia, I mean, obviously Veolia was on stop for a while, and steadily through the restart of that operation, the pit was already available, the box cut was there, the plant was built, and once we finished the commissioning process with the handover of the plant at the end of February, we were able to start washing properly, and now it's a matter of once we complete our product testing and talk to our customers. There's a roadshow that takes place this week in India. We'll then be able to establish the market and the client base for the product, and then we can start moving up the production and start to trend towards our target of 2.7 million ROM tons per year production and 1 million tons saleable.
To what extent are we looking at a cleaner and leaner machine here? Because this period has also seen the disposal of various non-core assets to the organization, and it's been a period that's been labeled one of restructuring.
Absolutely. I mean, we've been very focused on a lot of corporate activities. First, there was the capital raising that we completed late last year, where we raised $106 million. We also secured a working capital finance facility with JP Morgan of $40 million, and we started to dispose of some non-core assets, some of which has been around for a while, but we're completing those transactions. Firstly, the NIMAG transaction through a management buyout, and that is close to completion, and we hope to finalize everything in the next month or so. And then the Halfontein the Halfontein thermal coal project, which is based in the Vereeniging area in the near Sasolburg. That's also nearing completion, and we hope to complete that transaction by the end of the year. So yes, it has been a matter of refocusing and to get back to our core business of obviously the big development projects, and then also our 2 thermal coal mines.
Well, we've had this opportunity being identified, you know, and the blue sky potential being identified as well. I mean, we've got a very fast-changing landscape that we're looking at. We're looking at this possible Glencore Extraterre transaction coming to the fore. What could that possibly mean for a company like Coal of Africa, where we know Glencore has been pretty active?
Well, it's very interesting. I mean, obviously, both Glencore and Extraterre are major players in South Africa, particularly in the thermal coal space. If you look at Coal of Africa as a business, our assets are predominantly coking coal assets. Obviously, there's thermal coal in there as well. But we certainly see ourselves as predominantly a coking coal company. And through the development of our various projects and tenements, that is where we see our market position going forward. So in terms of from a Glencore Extraterre point of view, to the extent that we have a different mix compared to their thermal footprint, maybe we'd be of interest to someone like them. But certainly it's complementary to their business.
It was certainly complementary, and we've seen just how much. So in terms of other transactions, because as I say, we're seeing a landscape that's fast changing. We've got the vital Grindrod tie-up happening as well. What does that spell for a company like Coal of Africa in terms of exploring other avenues for exporting coal?
Well, obviously, our access to the Matola port has been something we've had for a while. It's very important to our business. Obviously, it provides us a route to the international markets. And obviously, we're been in there as a partner for a couple of years. We have the entitlement at the moment, and also the option to participate in the expansion of that port through what they call Phase 4. The investment by Vitol into Grindrod and the Matola port we see as very positive. Vitol has a small shareholding in our business. We do trading with them, and they're obviously, internationally, they run a number of ports around the world, and we see their involvement as being very positive, and only to assist us further in accessing markets and driving our costs down by creating better throughput rates.
Well, we'll be taking a look at that progress on growth moving forward. Thanks so much, Wayne, for joining us in studio this afternoon. Of course, Wayne Koonin is a Financial Director over at Coal of Africa.